Hello, and welcome to another Webinar Wednesday by Smart Karma. I'm Michael Tegos. Today, I'm happy to welcome insight provider Eric Fernandez. Eric will outline some of his top short trade ideas in the US market based on his unique and comprehensive framework for identifying short sell candidates. Eric has more than 30 years of research and investment banking experience in company modeling, equity valuation, and credit, which forms the backbone of the approach by Two Rivers Analytics, the company that he founded. Eric, let me welcome you to the webinar. Thank you very much for being with us today. The floor is yours.
Great, thank you. And thank you very much for hosting the call. Thank you to Smart Karma and to all of the people on the call today. Good afternoon to you. We're going to be a little bit ambitious in terms of the number of slides that we'll run through today. So we're going to make this very quick and have time at the end for Q&A for anything that I might have missed in the interim. Okay, first, very quickly, I'll tell you a little bit about Two Rivers, tell you about how we find good short ideas. We'll launch into a quick summary of what's going on in the short market, and then 6 short ideas, time permitting. Right, so Two Rivers, it's an institutional equity firm. We focus solely on providing short ideas in the US, in US equities. We've been around since 2010. We like to think we have a very robust process for finding good shorts. We provide short research, model rankings from our various models, which I'll explain in a moment. Mid-process reports where we talk about names that are somewhere between the model and the fully developed fundamental reports, and then we have short updates where we discuss what's going on in the short market, where movements, industries and sectors, and where companies might be at risk of short squeezes and similar work. Our framework is as follows. We have a series of purpose-built models that are built to identify different types of short candidates. They're listed there, I won't repeat them, but they all have very different characteristics and very different personalities. And they're outlined in this slide, which I won't go over in detail, but they're effectively makes that point. Hit rates are different. Some of the types of short candidates that are surfaced by these models are very idiosyncratic in nature. For instance, your earnings quality types of shorts. And others tend to be more thematic, say your declining business shorts. Some produce returns over a long period of time, and some produce returns very quickly and abruptly when something significant breaks, like an over-earner or a breaking growth type of short. Right, so what's going on in the short market today? Except for yesterday, we had the shorts have been underperforming significantly after a squeeze that we had in November. And what we're seeing in terms of industry and sector movements are at the bottom left there. We have telecom equipment and internet retail e-commerce representing a significant portion of new shorting, whereas we have packaged software, REITs, banks, where we're seeing the most short covering. Okay. We track a series of risk factors because that gives us a better indication of where we are in any given short-term, short cycle, if you will. And what we're seeing right now, should not be a surprise to anyone, is that the risk factors are sliding, again, barring yesterday, with small caps and unprofitable companies, especially hard hit. Cyclicals and levers continue to do well, but most interesting, what I find over here is on the momentum side, that momentum has tapered off, but still continues to perform reasonably well over the past several months. Okay, let's jump into the ideas. Again, 6 ideas here. They represent a sampling out of our various models. Most of these are over earners, but there are declining business models, declining businesses as well. So let's just jump into the first one and motor on through. All right, the first one is AtCore Inc. This comes out of our over earners model. And this is a pretty simple thesis, but before we go into the thesis, let's talk about what the company does. The company is a manufacturer of electrical products, PVC and steel conduit, basically things that protect or support wire in a building, in residential or non-residential construction. The bulk of what they do is in the non-residential market. Okay. Right. So why are we interested in Atkore? Well, effectively, what happened, if you recall, back in February, but even before that, when the civil unrest of 2020 hit, and then COVID all during 2020, there was a bit of a mass urban exodus to the suburbs. A number of people started leaving the city, and there was increased housing demand outside. And now we roll over to 2021, and we have a very severe freeze in Texas, which had the result of shutting down power in many places across the state, and many intermediate or PVC resin plants and intermediate products plants were shut down. And they were shut down in such a fashion, or so quickly, that many of the intermediate products that were in the pipelines transferring among the plants actually froze. So it caused quite a lot of disruption downstream. And you see on the upper right-hand side, the PVC record, you see the PVC prices spiked, effectively almost tripling in a very short period of time. So Atkore, being the market leader here, they have about 38 plants in the US. They actually had the PVC inventory to fulfill this demand, so they were able to increase the prices very dramatically. Part of the reason they can do that is because PVC represents a very small portion of the total cost in any construction project, but if it's held up, it has the same impact. It's a construction project, you're paying interest, insurance, et cetera, so it's very meaningful to be able to deliver product. So they raise the product in many cases, as much as 89% across the company, and with it, you saw the gross margin spike as well. But what's happening now is that those upstream plants are coming back online. The PVC plants are reopening, and there's a bit of a lull in the winter, in the construction cadence, if you will, in the winter, and that's allowing PVC resins and pipe to flow back into the channel and refill. So what that does is it makes ATR's competitors relevant again, and price competition will return, and those prices should drop fairly dramatically. So when we look over at the estimate side, we see that the estimates don't really account for much of a what we call a give back on those revenues and those prices. So the estimates are still higher than they should be. Multiples nearly ignore margin reversion entirely. So the upper right-hand side, you can see what happened quite dramatic to the margins. We spiked from somewhere about 15% up to 30% on the EBITDA side. And if you look at the multiples on the lower right-hand side, you see that effectively we're trading on peak multiples on peak margins. So we've effectively discussed the catalyst already. Slowdown in sales, collapse of selling prices, and contraction of profit margins should bring more normalcy to the company's P&L. On the risks, you have a secular trend towards digitalization, so data center growth, hospital growth. They both use a lot of wiring, so those are bullish tailwinds. So that's Atkore. Let's move on to another one. This name's a little bit controversial because it is effectively a higher quality company, but we think at this point it does represent, the stock itself represents a good short sale candidate. This is another over-earner. So Danaher manufactures and markets a whole broad range of life science research tools. They have equipment, instruments, reagents, consumables, and software, as well as a smaller business in environmental products and service, primarily life science and diagnostics. Okay. Part of their business is in equipment and diagnostic testing, which means that when COVID surfaced, we had very sharp spikes across product. So life sciences and diagnostics, most prominently. You'll notice here that growth had been slowing and had reached about 5% before the pandemic hit. So significant slowdown there. Much of their sales growth had been through acquisition. Okay. A couple of other things that were going on here is that within the sales mix, it had shifted significantly over to the consumable side. So people would purchase the piece of equipment for COVID testing for their patients, and then they would need all the reagents and the kits that would go along with that. So equipment sales were pulled forward from subsequent years, and consumable sales obviously spiked. Okay. We think estimates are too high. Again, the street analysts seem to be extrapolating as oftentimes they do, and they don't seem to factor in any sort of a give back. So a couple of things we think happen here is that once the equipment that has been sold is in place, it's not going to need to be sold again in the next 12 to 24 months. So we expect to see several quarters of effectively collapsing equipment sales, and the consumable sales will naturally taper off as the pandemic wanes. Okay, stock is very expensive, so peak multiples on peak margins. And I think in terms of risks here, we could see additional COVID variants, and there are some positive smaller parts of the business, but that are growing quite nicely and have high margins. So they include gene therapy, monoclonal antibodies, and other bioprocess sorts of business lines. Okay. Next up is Service Corp International. This is an over-earner. This one seems intuitively obvious initially, but it has some nuances. So first, just a moment, it's a bit of an odd company to talk about because it is after all, it's the largest funeral provider and cemetery owner in the United States. So, with so understanding the sensitivities here and our condolences to all those affected. So Service Corp benefited from a large number of funerals and deaths that were pulled forward from subsequent years. Again, it was a relatively slow growth company, but sales were pulled in due to the excess mortality around COVID. And you see the excess mortality here on the lower left-hand side. That's solely for the US market. You can see that quite dramatically. Okay. Tragically, COVID did not affect everyone equally. Perhaps that's not tragic. It seems to have taken from us the older people and sicker people. So by implication, the people that remain are slightly healthier and slightly younger. So what we foresee on the lower right-hand side there, you will see that if you look at the blue shaded area, that is the ongoing trend or the pre-COVID trend. You see the acceleration with the green triangle, and then after that is the period under contention. The street seems to think that SCI returns to trend, whereas we believe that SCI effectively needs to give back those sales, again, tragically deaths that are represented by the green triangle. So we have factored in a number of different models in our work, and we looked at at that cluster of people, effectively modeling out when they would have otherwise died over the next several years, and that represents a below trend portion of revenues for SCI that we should see in the coming years. Okay. A couple of other secular trends. Some positives: population is aging in the US, but life expectancy is stalled, and the US market remains highly fragmented. This is an acquisition-driven company. They make small tuck-in acquisitions fairly frequently. On the negatives, population is not growing. There is a strong secular shift towards lower price funeral services and especially cremations, and those now exceed 50% of total death care, and average prices will be under pressure for that very reason. So other issues, there's significant litigation going on regarding the company's sales practices, especially for pre-need, so-called pre-need sales. And there's some equity risk. All of the money that they receive pre-need and the money they need to keep aside for cemetery are invested in equities. Are invested in trust funds, of which about 60% is in equities right now. So they have significant equity exposure. Multiples are too high, and estimates are too high as well. Okay, we've effectively run through this. What are the risks? They have an e-commerce component to their business. It's small. It has not moved market share yet, but there's some possibility that it increases and it allows them to do so a bit faster. Okay. That's Service Corp. Okay, let's talk about Monroe. Monroe is a different kind of short. It's a declining business short. It's a company that has fundamental secular issues with the industry. And we think they're making quite a bad business decision in their sales mix. So what does Monroe do? They primarily sell and install tires, but a significant portion of the business as well is maintenance services. So they do brakes, routine mufflers, steering, drivetrain, things like that. All right. Monroe's sales have basically been slowing for some period of time, and over the past several years, their sales growth have been hovering about zero on a same-store basis. Right? Some growth had come in from tuck-in acquisitions, but basically the company had been slowing. Okay? Very little in e-commerce, even though there's a significant shift in the industry towards e-commerce, buying your tires online. Okay? This is effectively a secular decline story. The retail tire industry is growing more slowly than GDP. Miles of peak per capita. Electric vehicles require fewer parts. So this is not a great business to be in long term. Margins have been declining for some time. There was a very slight uptick in the last quarter. And that's effectively because the company had deferred some business or was forced to defer some business during COVID. Some of that has come back. Company is highly levered. About 4.5 times trailing EBITDA. And we do have some maturities coming in 2024. Margins we're expecting them to break they have a declining trend, and the sell side is expecting them to come up rapidly or recover from that declining trend. We don't think that's going to happen. One of the key things here that that I passed over earlier is that the company is making a conscious decision to focus more on selling and installing tires. That is effectively much lower margin business than the service business, and we think this is going to hurt margins into the future. They expect that they're going to be able to use better pricing mechanisms to price their tires and gain market share in tires. We don't see any reason to believe that, and we think they're going to sacrifice margin needlessly from the service business to the distribution of tires. Stock has gotten less expensive, and that's classic for declining business types of shorts. These tend to be sometimes called value traps or catching falling knives. They tend to be short going in, and they tend to have very similar types of risk. One is high short interest. Another is that with the cash flows in the companies typically generate a fair amount of cash flow as they decline, and that lets you do share buybacks or potentially becomes attractive to a buyout sponsor, to a private equity firm. Okay. Next up is ABM Industries. This is another overearner. Okay. They provide facility services for all sorts of large buildings, commercial, industrial, schools, and it's very basic services: janitorial, parking, rental cars, catering, that sort of thing. It's 93% a U.S. company. Okay. Very low growth, low margin. These folks earn a bit of margin on their labor costs, so they tend to have large labor pools, and they make a small markup on that as they send their army of workers out to the companies. Okay, there's some secular trends that are working against them, which are important. One is that sublease office offers are at high levels. The shift towards remote work, which was well in place before COVID, was accelerated during COVID, and the global working from home phenomenon is, we think it does not come back to levels that we saw pre-COVID, so that's going to continue. Margins have spiked to unsustainable levels. A couple of things here. The main drivers are, one is that ABM introduced an enhanced clean product just a deeper cleaning for office spaces. They charged a premium for that. That was a successful product. And also there's significant efficiencies in cleaning unoccupied buildings. And they managed their labor costs very aggressively. So they pulled back very sharp. When you look at the estimates, what the street is expecting, you see that the street is expecting margins that are higher than they ever have been in a steady state in the past, meaning that they expect, implicitly, they expect the enhanced clean product or those efficiencies to remain in place forever. We don't think that's the case. The key line to focus on here on this slide is the blue line, which is the business and industry client mix, end user. That's the important one. Aviation is still fairly small. And margins have fallen for anything related to earnings, but if you look at anything related to sales, EV to sales, for instance, that shows you quite succinctly that the margin forecasts are out of whack. So we think the appropriate way to look at this is it's not on an earnings basis with the inflated margins. Okay. Quick on catalysts and risks. The key risk here is that they can pick up smaller tuck-in acquisitions at perhaps better prices if other competitors have are experiencing some distress, and the aviation business has some legs to it, no pun intended. So it could provide some earnings uplift in the future. Okay. Last up is the Renewable Energy Group. This is a company that is focused primarily on recycling, effectively a series of lipids used cooking oil, soybean oil, etc., and they convert it into primarily biodiesel. Now, there's the key difference here is that biodiesel is effectively inferior to renewable diesels. They use the same feedstocks, but it's a difficult chemical process. And the biodiesel piece injects oxygen into, as part of this process, injects oxygen into the production stream, and you have to, with the effect of it's being a little bit more environmentally polluting, and you also need to mix it with standard fossil petroleum diesel. So that's those are disadvantages. So renewable energy focuses primarily on the less desirable biodiesel. Right now, that's a significant portion of its capacity, with very small capacity for renewable diesel, although plant expansion is going to improve the mix a bit. Okay. What's happening in the market is that renewable diesel is ramping very aggressively. The biodiesel tends to be manufactured by agricultural producers. The shift in the market is that the renewable diesel capacity, which is spiking, is actually controlled by many of the oil majors. These are Marathon, Phillips 66, and others. And that's because you can convert a petroleum diesel refinery into renewable diesel. It's not painless, but it's substantially faster than doing a greenfield development. Most of the new capacity is near California, which is where they have the LCFS credits, which I'll discuss in a moment. And Reggie's refinery, or Renewable Energy's refinery, is based in Louisiana. So it's is less able to take advantage of those attractive credits. Okay. There will be an effect on feedstocks here. We can see it already. Soybean oil has diverged from soybean meal, and that's going to be one of the key feedstocks going forward. Another concern of the feedstocks, obviously, is that if renewable energy is forced to compete with Marathon and Murphy and Phillips 66 for feedstocks, we expect that they will end up on the losing end of that trade. Okay. Their plant expansion leaves them behind. Still, they will still be less than 50% renewable diesel, and they have all of the expensive capital equipment invested already in biodiesel. That leaves them at a disadvantage. Okay. Company is completely dependent on subsidies. Just to be clear here, over the last 9 months, they've generated $500 million in subsidies, and their operating profit was a third as much, or 180 million. So this is 24% of revenues that come in from government incentives. One very important one is is the LCFS in California. This is effectively a program that taxes more polluting fuels to generate credits for companies that manufacture or use less polluting fuels. And you can see that they're trying to force the market to adapt to increasingly stringent environmental regulations. Okay. Problem is that this program is revenue agnostic. So eventually, even revenue diesel will be supplanted by other ways to generate these credits. Okay. So the company's growth is frankly all over the place. It's very volatile, but we think that what happens here is that Wall Street doesn't factor in that biodiesel volumes are going to decrease as soon as we have additional renewable diesel flowing through renewable energy. Okay. And of course, the margin squeeze with the feedstock competition. So higher multiples than we would like. Risks on this one is that renewable energy may find some better markets in shipping, which is more accessible through Louisiana. And there might be some acquisition risk from companies, from some of the oil majors that are looking for capacity in renewable diesel. And I think with that, I will stop talking mercifully, and I'll open the floor up to questions.
Thank you very much, Eric. That was a great presentation. And I, for one, was very interested, so no need to put yourself down like that. As Eric said, if you have any questions, please share them now through the Q&A button. We already have a question from an attendee asking, how do you manage the risk of short squeezes?
The way we manage risk of short squeezes, it's very simple. We try to avoid those companies that have excessive short interest. So as a general rule, we are hesitant to write about any names that have short interest higher than about 10%. And we get very nervous if it starts getting above 13, 14%. So we just, we steer away from those names, frankly.
Got it. Thank you very much. A question is, how many ideas does Two Rivers typically publish per month or per year? Broader topic question, I guess.
Sure. We typically target about one fully developed fundamental idea per month. And in addition to that, we do supply, we give you the updates from our models, and then we have discussion on about 5 or 6 names approximately weekly. So it could be somewhere between 4 and 5 names weekly, say.
Thank you for that. One of the risks that you mentioned, and I guess a kind of trend in the companies that you talked about is that some of them benefited from the onset of the pandemic, which in a lot of ways we keep expecting for it to wane, to sort of die down, but somehow it keeps kind of coming back. I guess in different having different impacts each time. So how much of a risk is that to your theses, do you think, the sort of uncertainty that we're seeing with the pandemic?
Well, I think clearly it does pose something of a risk, but I guess ultimately our view is that the vaccinations are in the market. We now have new therapeutics, or just about to have approvals on some new therapeutics that will help mitigate the damage from COVID. And perhaps, and this is my speculation, I am not qualified for this opinion, but I do think that the latest variant of concern, that the Omicron variant may in fact be a blessing in disguise. It seems to be less virulent, and it may drive out, being more contagious, may drive out the other variants, and in a sense get us all towards something closer to herd immunity. So it's that's purely speculative, but I would say, you know, it is a slight risk to some of these theses, but frankly, it will go away at one point. and it may just may simply just extend the period during which the or before before the stock reacts.
Understood. Thank you for that. An attendee asks, have the models been back tested and how have they performed?
The models are actually more fundamental tools than they are black box quant back tested. Okay, so what they do is they propose a series of candidates, and then we do the fundamental work behind that to drive down to see what's actually triggering the model and to eliminate the type 1 errors, effectively the false positives. So they're not sort of black box concepts that you would actually back test.
Understood. When it comes to I'm going to mention the pandemic again, but when it comes to the tech sector, there have been quite a few stocks that also benefited from the trends that we saw during the pandemic. Have you observed any potential shorts in that regard?
We've seen some, yes, but there I think that what we focused on in the pandemic, and we actually did a piece called Corona Over Earners that we put out in April of 2020. But we are more comfortable calling out specific items that we think have to revert in the short term, and that points you a little bit more towards companies that have margin spikes that are not entirely related just to the sales spike. So if there's something else underneath it, for instance, okay, like in the case of Service Corp, there's and not to put too fine a point on it, but that bump in sales or that rise in sales cannot be repeated and was brought back and has to be effectively repaid from a revenue standpoint. Or in the case of Atkore, well, Atkore's not a Corona. So I would say probably it's to focus more on margins than on sales.
Understood. Thank you for that. When speaking about companies like Danaher and renewable fuels, you mentioned in the risks some of the potential pivots that they could be exploring. Have you observed, or actually, could you comment on their ability to perform such pivots from what you've observed? Could they successfully pull those off and affect your thesis, do you think?
Well, we don't think ultimately that it affects the theses, but in the case of Danaher, I'm going to say that this is a higher quality company, and that they have been able to manage acquisitions in the past. Okay? So they have some new business lines which are exciting. Some of those are required. Most of them are acquired. Some are not. We think that ultimately that those segments have legs, but they are relatively small. So it's not going to move the needle for a $30 billion sales company in the short term as much as as the sudden disappearance of equipment sales and the shift in consumables. So yes, perhaps longer term that's a risk, but probably not in the short term. And in renewable fuels, frankly, they can build their plant. They're still going to be competing with they're still going to be competing on the feedstocks, and half of their installed base of equipment is going to be for a less desirable product. So I don't see how they dig themselves out of that one.
Understood. Thank you very much. If there are no other questions from the audience, we can put a full stop here. Thank you everyone for attending and for asking your questions. Of course, if you found this presentation valuable, I encourage you to look up Eric's profile on Smart Karma and to follow his work there, as he will be publishing a lot more. Eric, thank you very much for taking the time to be with us today and for sharing all your insights, answering all our questions. This has been very interesting.
It's my pleasure, and thank you all for attending.
Thank you, everyone, and goodbye.
Goodbye.